from its 52-week high. But another stock which is on our radar right now is MedPlus Health Services. Reported a strong revenue growth on a year-on-year basis. However, margins and profit actually for the company came in flat, and that's why the stock is down about 5% in today's trading session. We have with us Gangadi Madhukar Reddy, who's the MD and CEO of MedPlus. Thanks a lot, Mr. Reddy, for joining in. A good revenue growth that you saw, 29%. Can you first up, break up the sales coming in from your mature stores, new stores, digital and physical stores?
So for us, the digital has always been a small portion of our overall sales, especially because, we haven't really put in any additional discounts, promotional offers, or, have spent too much of ad money. So that remains at around 6% or so. But otherwise, our stores are tracking to the usual trajectory, which is, typically the stores break even in 3 to 6 months, and after that they get to a 10% or thereabouts EBITDA within 2 years. Given that the network is, almost 50% of it is under 2 years, you can, just make the split. I don't have the exact numbers, but yeah, this is on the back of both same-store sales growth as well as new store addition, the 30% growth year-on-year.
Okay. Mr. Reddy, hi, welcome to the show. Well, one particular trend which stood out to me when Metropolis and Thyrocare spoke about their numbers in the conference call was what they are seeing with regards to these online aggregators, at least when it comes to diagnostic testing. That volumes have fallen because these online aggregators are now looking at profitability, and hence they are not competing as aggressively when it comes to discounting. Is the same trend taking place in the pharmacy space, and hence has it been a windfall gain for you? Maybe not a windfall gain, but an incremental positive for you all?
Not really. Online has never been a very significant portion of the overall business, the pharmacy side, as you well know. Organized retail itself is around 10 to 12%, and and pharmacy, e-pharmacies were barely 3 to 4. So they are not really impacted any of our growth or sales or anything over the years. What we see,
there's no change, there's no rerouting of volumes is what I mean.
I'm sorry, I didn't get the question. What did you say?
For example, I would prefer to probably buy from an offline pharmacy as compared to an online pharmacy, simply because the discounts are not as much or equal to, say, a MedPlus. Is that a trend that you've probably noticed?
Honestly, that is on the marginal side, I would say. I know some of our online pharmacy guys are having a little bit of challenge. So the advertisement has come down a little bit for one of the players at least, but the others, are keeping it up. So, but that said, the impact of that is, I would say, much less than the overall trend of the Indian consumer to start moving towards the generic drugs. We are actually seeing a lot of people now basically understanding and, getting to this thing that 80% of the drugs sold in the Indian market are all off patent anyway. So they're all just made under different brands, and as long as they're sure about the quality, they're willing to actually go and buy, some of the generic drugs. We are seeing more of that, I would say, than any big shift towards or away from the online side, honestly. For us, despite the fact that online has actually gone down a little bit, one of the reasons why our, overall gross margins has come down a little bit is because the discounts have actually increased, which basically means the number of people who are buying above 1,000 has increased significantly, and hence the overall discount on the store has actually gone up from 17 to 17.4. So I'm not really seeing a big impact on the online side, I must say.
That people are now looking at generic as an alternative as well is an important and an interesting trend that you've mentioned. But let's talk about your operational performance itself. Discounting has gone up, as a result of which margins have come down as well. What are your thoughts on margins going ahead? And this largely because you have almost 4,000 stores. How many of them are mature? What's the margin profile of mature stores and the ones that have recently opened? As these mature, what is a sustainable margin that one should work with for a business like yours?
See, for us, it's still an evolving business out there. Everything is, changing. First it has the online or the lack of or whatever up there. Now it's a trend towards the genericization, I would say. To top it all, our own ability to do a lot of new things as our size grows, our ability to make more and more private labels is what will actually determine the overall margins for us. On the other question, 50% of our stores are less than 2-year-old, So they have still not yet matured. I would say that if the entire network were more than 2 years mature, that is, then we should easily see typical EBITDA at the company level of anywhere between 5 to 6% or even higher as we go forward. And that will be a result of slightly better buying, but more importantly, also shifting towards the private label products.
Okay, just a quick two-part question then, Mr. Reddy. One is private label sales. How is that done for you all this quarter? And two, if you could leave us with how the diagnostic business is performing.
Sure. Private label has actually come down a little bit, but that is expected. Typically, a lot of the private label in Q1 is slightly lower, mainly because you don't have any of the typical infections and everything else. And that's when more people come in and buy medications for headache, cough, cold, and also some antibiotics. So all that being slightly lesser, one should expect, and we did say that the Q1 was going to be slightly lower, and as expected, the Q1 private label is slightly lower, obviously. That's one of the reasons why the margins are slightly lesser this time. On the diagnostic side, what we said all along has been that it is a pilot where we are looking at a new subscription-based model. That model is actually playing out very well. We have in excess of 110,000 subscribers now all around Hyderabad. And these guys, obviously, once they subscribe, they're logged into our diagnostic center. We give a 75% discount. So the model is playing out the way we wanted it to, given that we are only in Hyderabad and we are an integrated, kind of diagnostic center with both radiology and pathology and biochemistry and all. The effect of discounting aggregators is not as high on us, I would say.
All right. Thanks a lot for joining in and giving us the views on your business going forward. We would have loved to know a little more on your plans from a longer term standpoint as well, but that conversation for another day. What we'll do is take a short break. On the other side, we have Amit Mahajan, who's the Director Technical and R&D at Paras Defense, joining in to talk about their first quarter numbers as well. Stay tuned.